So I was talking with one of my friends a couple of weeks ago, and I'm not going to call him out by name just in case he's watching, but we're just casually talking and the subject shifts over to money. And he comments to me, to my face, that he doesn't need to worry about money because 10% of his paycheck automatically goes to a savings account. There was just way too much to unpack at that lunch, but it did get me to thinking about how many money myths people take as fact. Today, let's debunk some of those myths. Hey, I'm Nikita, and let's start with that convo I had with my friend. Because here's the thing, the rule that says that you have to save 10% of your income, myth. Now, before you get up in arms because your mom said or you read it somewhere, hold on. I'm not saying that this isn't a great savings approach for some. I'm saying it's not a one-size-fits-all rule. Having money automatically disappear into a fund and then never doing anything with it isn't particularly effective. Is that going to be your retirement account money? Is it for an emergency fund? Are you still paying down high interest debts and making other smart money moves? If it's just your retirement money, let's be real. A 25-year-old setting aside 10% of a paycheck for retirement won't have the same impact as a 55-year-old doing the same. Let's just do some quick math. Say you start saving 10% at age 25 and you make $3,000 a month. So you're setting aside $300 monthly. At a 5% savings interest rate compounded over 40 years to age 65, you'd have $460,014. If you started saving the same amount at age 55 for 10 years, you'd have $47,079. So the sooner you start saving, the greater the impact. It might be a good idea to save a little more where possible if you're starting your savings closer to retirement age. But let's also keep in mind that saving 10% isn't always easy. If you live in an expensive area or are living paycheck to paycheck, it can be a hard standard to meet. And having a goal that you fail to achieve every month is going to make it difficult to keep yourself motivated. In a case like this, it might be prudent to pay down some debts and add to your income stream to strive for a savings goal that makes sense. Another common belief is that you can still make major purchases with bad credit. That's true. A credit score essentially judges you based on your relationship with debt. The higher your score, the more responsible you appear to the credit reporting bureau algorithms, and the happier lenders feel about letting you borrow money. None of this is to say that a lower score is necessarily a reflection of your creditworthiness or your level of responsibility with your finances. There are all sorts of circumstances that can come into play that lead millions into the lower score ranges. Banks recognize that. That's why there are several factors that go into loan approvals, not just your credit score. Lenders will typically also look at your debt to income ratios, the amount of money you have in the bank, and how long you've been employed. If you have a less than ideal credit score, it doesn't mean your dreams of home or car ownership are immediately dead. You may pay slightly higher interest rates or be required to put down a larger down payment, but you still have a chance at obtaining the purchase of your heart's desires. Another one I hear a lot, debit is better than credit. The reality? Myth. Better is a relative term though, so let me clarify what I mean by it. By better, I only mean that there aren't more positive financial implications by paying with a debit card over a credit card. With a debit card, you're using money you already have to pay for items, and the funds are pulled directly from the bank account. It's essentially like paying cash. A credit card is borrowing from a lender to cover a purchase, so every credit card swipe, regardless of the size, takes on a bit of debt. The obvious difference here is that debit cards don't come with interest, while credit cards do. And that matters. The average interest rate on a credit card is 20.40%, which can add up fast. The $100 you'd spend on a debit card would be $20 more on a credit card if you factor in the interest amount. And if you're rolling your eyes at me like, Nikita, this doesn't matter because I'm just gonna pay the bill off in full every month, I'd have to politely point out that the odds aren't really in your favor here. According to studies, only about 13% of credit card holders carry zero debt on their card bill month to month. If you're part of that 13%, awesome. But otherwise, using a credit card will result in paying more for a purchase than you would have had you used cash. This stat gives credit cards a pretty tough rep. But used responsibly, a credit card can be a great way to build your credit, get consumer purchase protections like extended warranties or insurance, and earn you travel rewards or other perks. Credit cards are also better for disputing a transaction in the event your card is hacked or compromised. If you're gonna spend more on a credit card than you can pay off monthly, it's probably best to avoid the purchase unless it's an emergency to spare yourself the debt. But if you can pay off the debt monthly, credit cards are a great way to go. Another belief I've heard a lot is that you don't need insurance. That's true, sometimes. I say true sometimes because technically you don't need most insurance. But insurance is there to save you a lot of potential financial headaches along the way. So it's good to have in the instance of most major investments. Insurance for your car? Always needed. It's illegal to drive without insurance in most states. Plus, the cost of covering damages in a car accident without insurance are astronomical. Health insurance for yourself and family is one you should have as well. It's no big secret that healthcare is expensive. An overnight stay in a hospital without insurance could run you an average of $9,300. You'll also want to get insurance for your home, whether you own or rent. Homeowners or renters insurance can both protect your finances in the event of the unexpected by covering the cost for replacing damaged items. And homeowners insurance covers the building and more. But there are also a ton of other insurance that you may not necessarily need. Identity theft insurance, that's designed to monitor your credit accounts for an annual fee, isn't really necessary. Now, don't get me wrong, fraud prevention measures are important. I'm just saying that insurance to cover it isn't necessarily something that you need. Most banks and credit card companies monitor this for their clients without an additional fee. The same is true for extended warranties, which are intended to be insurance for a set amount of time on a host of appliances and electronics. But buyers, statistically speaking, rarely actually use this. Stick with brand name products that are likely to work as advertised and skip paying the extended warranty fees. Car rental insurance is another thing you likely don't need. Many car insurance policies already protect you in a rental, so in most instances, it makes more sense to choose your policy over the fee. You may also have coverage for rentals through your credit card company. And this coverage would mostly apply to what's called a collision damage waiver or loss damage waiver, which is usually the most expensive coverage offered at the rental counter. Credit card insurance, unemployment insurance, and a bunch of other smaller insurances are also likely unnecessary. It's a much better investment of your funds to manage your money well and set some aside in a high-interest savings account to cover your bills should the unexpected occur. Another thing that many believe is that you only need a will if you're wealthy or have kids. That's a myth. It's not particularly fun to think about, but who gets Fido or your vintage collection of Disney-themed vinyl or the 1965.5 Mustang convertible in cherry red that you're rebuilding if you die? A will is a relatively easy way to make sure your assets go to the right place, and it doesn't have to be real estate property or other substantial assets to be important. A will can account for anything that you value and want to ensure gets well loved and taken care of. With the will and testament, you'd work with an attorney and choose an executor to handle estate affairs upon your death. These affairs can include the guardianship of your kids or pets, distribution of property and assets, plus your funeral arrangements. Even if you don't have kids or own property, a will can help your loved ones left behind understand how to distribute any money or possessions and how to honor your wishes for the funeral. And one last thing that we have to talk about, because everybody is popping up married or engaged lately, is the idea that getting hitched automatically means your finances are linked too. That's a myth. The whole concept of what's mine is yours has its limitations, and debt and other financial considerations are amongst those limits. The only way that you would be linked to someone else financially is if you take out a joint financial product together, like a mortgage, loan, or a bank account. Once you do that, then yeah, your credit records become connected. At that point, your individual credit transactions could impact each other's scores. Lenders may also look at both of your credit reports moving forward, even if only one of you is applying. This is why it's so important to talk about finances with your partner before getting married. Not because your money is automatically connected, but because you'll want to both be on the same page before you get married or take out any credit together. And I do want to add that just because your finances become intertwined when you take out financial products together, doesn't mean it has to stay connected forever. If you had an account together at one point but don't share any joint accounts anymore, you can ask the credit reference agencies for financial disassociation to unlink your credit records. Once that is completed, the other person's credit records won't impact your score anymore. Okay, y'all, I'm gonna go ahead and wrap this up because there's just so much inaccurate financial advice out there that I could just go on and on forever. But I hope this video got you thinking about some of the financial things that you've taken as fact over the years and has inspired you to dig deeper into them to see how accurate they are. Maybe you'll save yourself a little time, money, or headaches along the way once you sort out the real from the fake. The money myth that I functioned under until well into college was the idea that I only needed to care about my credit when I was ready to buy a house or a car. Definitely a good idea to keep an eye on that all the time, not just when you want to get a good rate on something.